time now for the day's business news. China is expecting to see twice as many people traveling during the upcoming Lunar New Year holiday compared to last year. Our business editor, Yuka Royer, is here with the numbers. Yuka.
Well, Erin, 2.1 billion trips are expected to be made during the 40-day travel period starting tomorrow, up 99.5% from 2022. The Chinese New Year period is the busiest travel season in the world, when workers across the country return home to spend time with their families. According to the Transport Ministry, visiting relatives will account for 55% of the passenger flow. The Year of the Rabbit starts on the 22nd of January, and it's the first major holiday since COVID restrictions were lifted. It's going to be challenging, though, for officials trying to keep the virus at bay, as the sudden easing of China's zero COVID policy has triggered a new wave of infections. Let's take a lesson.
This year's Lunar New Year travel rush will start on 7th of January and end on the 15th of February, a total of 40 days. Compared with previous years, this year's Lunar New Year travel rush will be the most uncertain, complex, and challenging one in recent years, as the peak of the passenger flow and the peak of the pandemic overlap.
Well, China is also opening its international borders. Starting on Sunday, it will lift its quarantine requirements for people coming into the country from abroad. However, many countries have reimposed tighter restrictions on passengers coming from China, worried about the rapid rate of infections there. Businesses, though, are hoping to see Chinese tourists return soon, especially here in Europe, where recession is looming on the horizon. Camille Knight has more.
It was great news for the global luxury retail market. Beijing's decision to ease travel restrictions brought back the prospect of Chinese visitors flocking to shopping hubs from Paris to Tokyo. And markets reacted accordingly. Shares in most luxury groups, including LVMH, all jumped after the announcement. But analysts are warning not to expect an immediate return to pre-pandemic levels of Chinese travellers.
Regarding the recovery of the Greater China market, we still think we need to be patient a little bit. We are expecting already 43% of travelers back in 2023, and then towards 2024, maybe around 80%, and then a full recovery at the end of 2025 or 26.
Something else to look out for: big luxury brands have been increasingly investing in the shopping experience in China. Under pandemic travel curbs, China's domestic luxury sales doubled. So it's unlikely Chinese shoppers will continue to buy 70% of their luxury goods abroad like they did in early 2020. But that doesn't mean it's the end of shopping holidays. For many Chinese customers, the broader offerings of luxury goods overseas means travel will definitely be back on the agenda. And with the threat of recessions in the US and Europe, there is hope that China's reopening will offset some of that economic slowdown.
That was Camille Knight reporting there. Let's check in on the day's trading action now. And Asian stocks have been mostly up in their first trading week of the year, with a host of encouraging economic data coming from China lifting prices. As you can see, Shanghai Composite, both Hong Kong and Shanghai, up above the flat line. Tokyo up by 0.5 percentage point, and Seoul's Kospi up 1.5%. Now, staying in South Korea, shares in Samsung Electronics rose modestly, up 1%, as you can see there, despite a dismal profit estimate. The South Korean electronics giant said operating profit for the October-December quarter likely fell 69% as a weakening global economy weakened demand for electronic devices. It marks Samsung's smallest quarterly profit in 8 years. Global oil prices are extending their gains today, with both the international Brent and the American WTI currently up by 0.6%. This on hopes of China's economic recovery boosting demand, as well as on reports of lower fuel stock in the United States following a recent winter storm. Moving on, US antitrust regulators say workers who left one company should be free to work for its rival. The Federal Trade Commission proposed a rule that would ban employers from forcing workers to sign non-compete agreements upon leaving, saying such clauses were exploitative. The agency estimates that if the rule goes into effect, wages to US workers would rise by $300 billion per year, and 30 million Americans would have better career opportunities. Erin.
Yuka Roye with Business. Thank you very much.